Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investments from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Xiao Yuan. Xiao is the managing director of Hagmann Capital and manages the day-to-day operations, as well as leading all bond structuring and negotiations for Hagmann Capital portfolio. And in just a minute, we're going to speak with Xiao about TIF bonds. That's the Tax Increment Financing bonds, and what they are and how they are used. But first, a couple things. If you like our show, you can help us out. You can like, share, and comment on our podcast here. We always love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Xiao Yuan. Welcome to CRE PN Radio.
Darren, thanks for having me. Appreciate you taking the time to learn a little bit more about what I do.
Well, I'm really looking forward to this. I did a little research before, preparing for this, and it was kind of fascinating. I'm dying to learn more about it. So, but before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I'm Xiao Yuan. I am the managing director of Hagmann Capital. So Hagmann Capital is a entity that we created in late 2020 to purchase developer-backed TIF bonds. So prior to really creating Hagmann Capital, the Hagmann family, the farming family out of Remington, Indiana, who Steve Hagmann, the patriarch of the family, started a seed company and sold it in 2013. And so that created a liquidity event for us to really invest in, I would say, traditional commercial real estate and some private equity plays as well. And so our focus originally at Hagmann was mostly commercial real estate. We were LP and JV investors in a lot of multifamily deals. But what we realized was that we saw a trend in the commercial real estate space, at least in central Indiana and a lot of the Midwest, was that developers were asked to essentially buy their own tax increment financing bonds. So the way that municipalities used to do it is that they would use really all future property taxes of maybe a very large TIF district or in the entire municipality itself to incentivize a project. But really, the last few years, municipalities realized that's not something they wanted to do. They didn't want to put their credit on the line. And so instead, what they did was ask the developers to support their own project by essentially promising the future tax revenues generated from their project. And so that created a void in that, municipal backed TIF bonds have a pretty high rating, typically very high investment grade rating. What developer backed projects are is that it really is, the credit of the developer. And there really isn't much more to it, right? So it's, if the developer or the property owner can pay your taxes and if taxes stay high, you as the bondholder would get paid, and typically, that is not that's not a very marketable security, or it lacks a lot of liquidity. So what Hagmann realized is that we're typically really good at understanding commercial real estate risk. All we're really doing now is applying it to to, tax increment financing bonds that, we understood property taxes, we understood development risk, we understood construction risk. We've taken on those risks ourselves. So, what's the difference if we were to essentially do that with a bond? And so that's how Hagmann Capital was created, was to really provide liquidity in a space that lacked liquidity or not a lot of folks were engaged in. And, our expertise really is not just real estate, but it's also, bond structuring as well. So my background was in capital markets at a large regional bank. And my specialty was in high yield municipal finance. So prior to joining Hagmann, that's what I was doing. And TIF really was a big part of it. So that's just a little bit about us and, kind of how we operate and really history of the company.
No, I appreciate you, sharing that, because that's kind of fundamental to understanding what you guys are and kind of what to talk about. So I want to first kind of differentiate them and make sure I understand. So bonds are debt, right? I mean,
Correct.
so the TIF bonds, you mentioned the developer-backed TIF bonds. Were they previously? I thought I heard you say that primarily they were municipality backed bonds. Did I hear that right?
Yeah. So, the way that most developers would get incentives on the project, back in the day, what ultimately would happen is, a developer would go to a municipality and say, hey, look, my project currently costs X and, it has a return of Y, but this return is too low that my bank is not willing to do it. My equity partners aren't willing to do it. It's not a bankable deal, right? So in order for me to go and engage this project, embark on this project, I need some municipal incentives. And so, TIF is just a form of a municipal incentive for the developer to build a project. So you can kind of think about it as it's really buying down the amount of equity needed to really sort of create, a more robust real estate return, right? But back in the day, what a municipality would do is they say, hey, we'll give you the tax increment financing incentives, but so we'll go out and issue a bond. But if, let's say, the property taxes from your bond doesn't cover the debt service because, for whatever reason, maybe your project is delayed or the assessor's office is, very generous to you for whatever reason, there may be sort of a shortfall between the bond debt service and the revenues that are generated from just your project. And so what municipalities used to do is say, if that were to happen, we will pledge other revenue sources, typically sort of the gross collective property taxes of this taxing district to repay the bonds, right? And so obviously the cost of financing in those such situations is that it's really kind of a municipal credit at that point, right? The backstop is the municipality. And so while the financing costs were extremely cheap, the risk component for the municipality is much higher. They're really taking on higher risk, more risk by doing so, especially if a project ends up maybe not being what it was built to be. And so the recent trend, at least in Indiana, is that municipalities have kind of gone away from this structure, but instead, they're telling the developers that, okay, we'll give you the TIF on, the future taxes generated from the property that you're about to build. But if there's a shortfall and you can't pay the bondholders, we're not going to back it, right? So you, developer, will end up having to back it with your balance sheet or having to back it with, sort of, it's seen more as like non-recourse debt, recourse to real estate, but non-recourse to, developers themselves, right? And so that's really the distinction. And so overnight, you went from these, AA, AAA municipalities that are supporting tax increment financing debt to really these are just developer supported bonds, which it just doesn't trade as well in the marketplace. And so what we decided to do was essentially invest in the latter pool, right? Because we understand the risk, we understand, what is our worst case scenario if somebody doesn't pay our bond, right? So that's kind of I would say the high overview of what municipalities used to do when they were backing the bonds versus what they're doing now.
Got it. So a couple of questions from that. So my understanding, and I do a fair amount of like performance bonding for contractors now. And so having to be familiar with their balance sheets and how the underwriters always want there to be more cash than they need, so they can pay all their debts, and not have a claim against a bond on a performance bond. I'm assuming it'd be some similar underwriting that you guys look at when you're looking at these contractors. You mentioned, that they have enough of a balance sheet to pay the potential shortfall. Is that am I reading that right? Is that a lot of what you guys do when you're looking at a uh, a bond to buy? Is that, I mean, because you're essentially, are you not providing the capital to the contractor, or are you buying, you're buying the obligation for a rate of return from the contractor, or how's that structuring?
Yeah, so I mean, what we're really doing is we're providing capital to a developer that is getting this tax increment financing incentive, and so you do have to underwrite sponsor risk, but at the end of the day, right? I mean, the project produces income. It's not just I mean, these are commercial real estate projects that are income producing. We're not going to go buy a bond on a single family home that there is
Right.
not sort of this perpetual income, and like most commercial real estate developers, especially the good ones, right, is that they're going to pay their taxes on the property with income from the property. So we actually, I mean, we spend a lot more time looking at the actual development project itself as opposed to maybe the sponsor. Now, granted, sponsor reputation and sponsor risk is a real thing. And we do really heavily scrutinize that, but at the end of the day, if it's a good project and good sponsor, good developers, those are really the aspects that we're underwriting.
Got it. So it's more like just a commercial bank loan from a standpoint of you, the project, the viability of the project, more so than the actual the contractor.
Correct.
Gotcha. And so the debt, is there a lien position against the project if there was something went wrong? Are you in a position where you have any kind of a lien against the property?
Yeah. So tax increment financing is essentially taxes, right? So if
Right.
you don't, these are just future property taxes that are generated from your project. So the debt service on these bonds are directly from the taxes generated from the project. So, if you don't pay, debt service on your bond, typically what happens is you just didn't pay your taxes. So, in that sense, we do have a lien, right? We essentially have a tax lien that if you didn't pay your taxes, then there could be essentially a trigger foreclosure or a tax sale. Now, what's more likely to happen is the developer's construction lender or first mortgage holder is probably going to pay those taxes, just because they don't want to be wiped out by a position that is, essentially maybe 10 to 15% of the capital stack.
Right.
But ultimately, it's treated like a tax lien. Now, the only caveat is that if, let's say the assessor assesses the properties lower than what the debt service would be, then you technically wouldn't have a tax lien in those situations unless you have maybe some sort of a side agreement or a taxpayer agreement of some sort. So that's the caveat, right? It's that if there's enough taxes to pay debt service and somebody doesn't pay their taxes, then that's a tax lien. But if there's not enough assessed value in taxes to pay the debt service and somebody does pay their taxes, that's not necessarily a tax lien.
Got it. So, and just you brought up a couple of things that uh, as a bond, it's a debt, but it's strictly through the taxes that the payments to the bond are being made. Did I understand that right?
Correct.
Okay. And so if there's a lender, like you said, that if the taxes aren't getting paid, the lender would likely pay those. So your position in uh, the discharge of the property, if it were to go to foreclosure, you're not in first position. I assume the lender would be in first position. Is that
No, you are in first position because
okay?
it's a tax lien.
So it's above the taxes above
Yeah.
the lender. Okay, that's what I thought. But then,
Well, which is always the case, right? I mean,
right, right,
it doesn't matter, if you don't pay property taxes on your house. I mean, it doesn't matter how big your mortgage is, your
right.
mortgage lender is going to get wiped out. And that is kind of the nuance that I think you have to understand when you're looking at these deals, is that each different state have slightly different sort of tax sale procedures. In Indiana, it's generally pretty favorable to I would say it's more municipally favored. And so, we have really when we say, we have first position, we do, right? Now, granted, the sort of the other side of it is our capital also comes in before the construction lender. It's really TIF capital and TIF equity is really treated as, equity in the capital stack, and chances are that a lender is going to want to see that money come in first, right? So it's not sort of this, you're in the super protected position. It's that, taxes for whatever reason, if your project under taxes don't tend to do well, or the assessed values decrease, you are subject to those types of risks.
Got it. Got it. Um, so as far as the capital that you guys are putting up and its use, is it designated on more like infrastructure, or is it just a part of the whole project, or is there any primary way that the funds are used?
Yeah, so the answer is yes, right? The joke
Okay.
is TIF kind of falls in the gamut of infrastructure use. So, if let's say you build a commercial warehouse and you need to have roads leading up to it, TIF dollars can be used for that, or it could be used for parking garages. That is, resident accretive to your multifamily deal. But I mean, TIF can also go as far as potentially supporting bricks and sticks. So as really just kind of a part of the capital stack. So it's there's a wide range to it. That also kind of changed the taxability of the income from the bonds. So if you're essentially buying a bond that is only supporting infrastructure, there's some tax advantages compared to if you're buying a bond that potentially supports bricks and sticks, where you really can't get tax advantages in that sense.
Got it. And the bonds, so you guys are putting up the capital, the bond, is that, how is it? I guess what I'm trying to understand is the municipal agreement, is it just baked into the tax, or is part of what you're doing, is that going to affect tax rates? If I'm a member of the community, am I affected, or is it strictly related to that property and the tax base, or the
Yeah,
taxes owed by the property?
it's strictly related to the property itself, right? So,
Okay.
the really, we kind of joke, the best thing for the community is, some developer, getting a TIF that falls off after a certain amount of years, because all that tax base is going to go back to the community. And so, you as the resident is really not impacted by, if it's a developer backed bond, right? If there's a shortfall for any reason, if it can't pay debt service, your property taxes aren't going to go up because you own a house that's 3 blocks away. But ultimately that's kind of the advantage, right? That is really sort of more on the developer's shoulder. So it's not, it really doesn't impact tax rates. It's more just what is the actual taxes generated from the property you're going to build.
Got it. Okay, well, this is all starting to make more sense now that it is specific to the property. Because I was thinking when I was preparing for this, more like, a tax bond measure that you vote on based on they're going to do new schools or roads or whatever it is, or renew a bond for whatever it might be. And the public votes on that. But in this case, it sounds like is there a need for a vote, or is it more about it's the municipality is able to grant the status to the property itself, and that property then carries the weight of the bond. Um, and I say the municipality, but I want to make sure I understand. Does the municipality have to grant any status, or is that something strictly between you and the issuer of the bond and the payer, the developer?
Yeah, so a couple of answers. You asked a couple of questions. So the first
Okay,
question is, does there need to be a vote? The answer is not from the public, because it doesn't impact their tax rates. It doesn't impact how much taxes they're going to be paying as a result of this development. So there doesn't need to be a vote from the public. The second part is, the municipality ultimately needs to grant you the right for TIF, right? Because what you're really taking away is you're taking away their future taxes for a number of years that you get to monetize. So the only way that you can do that is essentially going through a municipal process in which they're granting
gotcha.
you the ability for TIF, right? Because what's ultimately happening is, on day one, if you just have a vacant piece of land, that doesn't generate a lot of tax revenue. The increment really comes from the fact that you build something that is more than just dirt. Let's call it 300 units of apartments. In that case, right, the taxes on 300 units is a lot more than no units. And so the difference of those taxes is the increment, right? So if you didn't do the project, what would have been the taxes versus if you did do the project, what would have been the taxes? And the difference in that is the increment. And so that is really what the municipality is allowing you to capture. So it's not that they're really taking money out of their pocket in that sense. It's that there has to be development in order for taxes to be there. And by allowing you to capture the increment, it's essentially building their tax base in the future, right? Because once
Yeah.
the sort of the TIF period runs off, the municipality captures the taxes that is generated from your development.
No, makes sense. I'm kind of slow at this, but I'm getting it as we're going through it here. It's just an interest. So it's the part of the capital stack. You get it by appealing to the municipality to grant the status, and then that allows the developer then to do they then engage with somebody like your firm, or who issues the I mean, because it's capital at that time. I mean, it's debt,
Yeah,
part of the project. So they have a plan, they have a budget, they have a lender that says they'll meet this much, or they'll lend this much. I'm assuming they have to come with some sort of equity themselves, the developer, the owner of the project, and then you're a part of that stack. Uh, am I is that
yes,
am I
yes,
saying it right there? Okay.
yeah.
And then my next question would be, so if a project does have a TIF bond that you guys are the issuer of, what's
Or
an average
purchaser, right?
purchaser
So
of? Okay.
yeah,
Yeah,
so issuer,
I'm not saying the words right there, but because you're putting the capital up, right? Or
yeah,
actually
what
you're
we're
buying the
doing
bond.
is
Yeah.
we're just buying the bond. Yeah,
Okay.
I'm not lending against it. We're just
Okay.
buying the bond.
But when you buy it, then you're going to receive payments from the revenue, right? Because you're
Correct,
now you own the debt.
correct.
So who issues the debt then originally? Is it the municipality?
Yeah, that's part of the granting process, right? Is that they allow the issuance of a bond. So this, what a bond is, it's like a note, right? I mean, it
Right.
just memorializes the obligation. And so what we're doing is we're essentially buying that obligation.
So is there any coordination between you and the municipality? I mean, what if so that they don't over obligate the property?
Yeah, typically what we'll do is, we'll sort of limit that based on any TIF obligation. Our bond is really the only obligation that can be encumbered on that, on that property itself, right? So I mean, there's definitely some coordination. Also there's really throughout the deal. I mean, we're really negotiating the terms of the bonds. What we like to see, what is our repayment source, how long the bond is, right? Sometimes they're statutorily, you're only allowed a certain number of years for TIF, just because the municipality needs to be able to capture the future increment at some point. So there's definitely some high level coordination between us, the developer, and the municipality. But really, I mean, the way we see it is, the developer who's essentially getting the equity, getting the capital, those are the folks that I think we interact with the most.
Yeah, no, it makes complete sense. And again, I appreciate you walking me through this, because I get the concepts, but some of the way the money moves, or the obligation moves, it takes a little hammering through there. So you mentioned the length of the term on these. What is an average length of a term on a TIF bond?
It varies state by state. In Indiana, it's 25 years. In Ohio, it's 30 years.
Wait,
Illinois, I think
you
it kind of
said
depends.
how many years in Indiana?
25.
Oh, 25. Okay. So it's like a commercial loan as far as the length of the bond payback time. What is and is it a fixed rate all the way through it then, or is there a
Yeah, for us, it's a fixed rate. What we can't do is, we're not buying a floating rate debt. So sort of on day one, right, you already have, you have to have kind of the capital stack already in place. So if the rate floats, right, even though your revenues don't change, you can't really have a situation where there's essentially less bonds, right? So for us at least, I mean, our money's in there for 25 years and it's fixed.
got it? So on the commercial lending side of things, a lot of times, loans get sold, or not so much on commercial, I guess, but on, like residential, there's been a lot of that. But is there a market for the bonds, or do you guys, you issue them, or you buy them and hold them, or do you ever sell them, or?
Uh, Historically, no. Our intent really is to buy and hold. And I think folks kind of like that as well, just from the sense that we're really long-term money. This is not a sort of get in, flip it out, get out type of play. And the kind of the way that we're structured too is, we're a family office. We're very long-term money. And the way that we look at, a lot of these transactions have very long time horizons. So, because of the lack of liquidity and the fact that, that's really not the investment thesis. We really have full intent that we're going to keep them.
Yeah, no, that's interesting. What's an average rate on a TIF bond?
So, I think that question really kind of comes down to a couple of factors, right? The easy way to answer that is, we're really going to be between what a commercial lender is going to charge on a first mortgage versus what your, preferred rate on equity is going to be. The reason is, what a first mortgage lender is really going to get is, their money is going to go in last, and they kind of take the least amount of construction risk. But we really, our rate really needs to be a little bit higher than theirs. But on the other end is, we're really not getting the pref upside, from an equity position. And, our capital is just not as risky as equity, right? Especially kind of based on where we are on the tax lien. So my comment has always been, it's really, that's the sweet spot, right? It's between what a first mortgage is and what equity is.
Got it. And as far as the repayment of the bond, does it have a declining principal owed, or is it just a length of time, or is there like on a regular commercial loan, amortized over, X number of years, there's a declining balance. Is that similar in the bond?
Yeah, I would say, bonds typically have like fixed nominations. So really what we're doing is, we're sizing to the amount of revenue that's available every year. So, typically if you look at a bond amortization schedule, in the earlier years, right, of where if you have a set number of, fixed revenue amount, you're going to pay more interest than principal. And, as you kind of move down the amortization schedule, it's going to be more principal than interest.
Got it. So in the type of projects, it didn't sound like you're really limited. It's all about the revenue side of the end use of the project. Is that pretty much what dictates? Yeah.
Yeah, we are selective in the projects that we may be interested in buying the bonds for. So typically we don't like to buy anything that is too special use. So if you want to build a building that looks like a basket, maybe not, right? But if it's just traditional, commercial real estate, retail, multifamily, industrial. I would say, we're very interested in that. So, rule of thumb is nothing too specialized, but generally sort of bread and butter real estate, the type of stuff that people want to build. Those are kind of the deals that, we like to see on when we're buying the TIF as well.
Got it. And is there a sweet spot as far as the size of the TIF that you guys purchase?
Yeah, so typically in the capital stack, TIF is anywhere from 10% to 15% of the full project cost. So, while in theory we could buy a 15 or $20 million bond, there's just not that many 150 to $200 million projects, right? So traditionally our sweet spot have been, anywhere north of, $1.5 million. Some of the larger deals that we've done have been in the 12 to $15 million range, but I would say on average, it's about $5 to $6 million, which equates to anywhere from a $40 to $60 million project.
Got it. So on that percentage basis of the total project, so if say you guys are coming in at 15%, I'm assuming is the lender, are they coming in at 80 or 75, or how much is the developer willing to come in? Or how
Yeah,
much are they required to bring? Because I'm assuming that this kind of, you help the project. I'm thinking.
sure. Yeah, so it really just depends on what the commercial lender is willing to do in terms of loan of cost. So some lenders back in the day were maybe willing to push 80%. But I would say these days, maybe we're closer to 70. So
Right.
let's say if we're 15% of the capital stack and the lender is 70%, then the developer needs to find another 15 somewhere. And typically
Right.
it's from them or their LP investors, for example.
Got it. Got it. No, that's fascinating. Just the whole, kind of the nature of the capital stack and uh, just the TIF bonds. I mean, I've heard of TIF bonds, but I never really paid that much attention to them. And you mentioned that at least in Indiana and kind of the states you're working in, that this has changed from more of the municipality backed to the developer backed. Is that a trend nationwide? Are you seeing that?
I would say some states are maybe even further along. Just because I would say, if you look at deals in Illinois, I mean, there's traditionally always been, you got the TIF, but you didn't get the municipal backing. So it kind of just depends. In cities and towns that are further along in their development cycle, there's just more attractive places to build. They're sort of less likely to give you, really, really strong incentives, right? And so those municipalities may have already been, sort of pushing developer-backed bonds for years and years. So I don't want to say it's a nationwide trend, since we're right now, at least we're still pretty focused in the Midwest. But it's, if you think about it from a policy perspective, it probably makes sense, right? That, what you don't want to happen is to have a failed commercial development project and the rest of your tax base has to pick up, so that's been the appeal for a lot of municipalities, is that they don't have to give, sort of a big credit enhancement in order for deals to still happen.
Right. And like you said, the goal, their goal is to have the project where you have a, potential downstream tax benefit as opposed to
Exactly.
just the raw ground. And also it fills a need in that there's likely a need for the project. If you're talking about multifamily or I mean, just the nature of demand and also that's jobs and housing and whatever else. So
Yeah. Yeah.
I'm guessing there's a lot of support from the municipalities for this type of financing.
Yeah, exactly. No, you're spot on that.
Got it. Well, hey, Xiao, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And when those are not options, we look to see if there's a way we can transfer the risk. That's what an insurance policy is, risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be clients, the economy, the political, market, however you want to identify and whatever you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Xiao Yuan, what is the biggest risk?
Yeah, like any financial product, I mean, it truly is interest rate risk. So, it's not something that you can eliminate. You can, transfer it to some extent, you can minimize it to some extent, but, on the day-to-day perspective, I mean, we do kind of see it as, anytime we buy a bond, anytime we, look at any type of these financings, day to day, proceeds can essentially get diminished simply because, 10-year treasury goes up by 15, 20 basis points, right? And so, that's something that, at least we spend a lot of time thinking about, is just how do we minimize the interest rate risk? And we do have kind of a few vehicles that we utilize to minimize interest rate risk, both for ourselves and also for the developers that are, seeking our capital. And, kind of a big way that we do that is, we created a rate lock mechanism anytime we buy a bond. So, whatever the interest rate is on the bonds, what we would do is, we can say, hey, we can lock in the rate for the next 5 to 6 months. And typically the way we do that is through kind of a series of, different swaps and sort of other interest rate management tools, right? So, but on any given day, I mean, what I think about the most is, how do we minimize interest rate risk? Because that's ultimately sort of the, volatile interest rate risk is really the sort of the enemy of solid, consistent return.
Yeah, no, it sounds like some challenging times right now, just based on the rates are changing and how it's changing the market. I mean, that's a real challenge. Uh, and it's funny because I know that historically rates have been higher, uh, but having been so low for so long, kind of that adjustment for people to adjust to and the market to adjust to where the whatever the market is and will be, so that it functions, is kind of the challenge and so I get it. I get it. Hey, Xiao, where can listeners go if they'd like to learn more or connect with you?
Sure. They can go on our website, hagmanncapital.com, to learn more about, what we're doing in the TIF space. If they want to learn more about the family office and our operations, they can go on hagmangroup.com. And I am on LinkedIn under XIAOOUYUAN.
Awesome. Well, Xiao, I cannot say thanks enough for taking the time to talk today. I've thoroughly enjoyed it, learned a lot, and look forward to doing it again soon.
Darren, thank you so much. Appreciate you having me on, and appreciate it. And hopefully your listeners can get something out of this as well.
Well, I'm certain they can. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.